solely yourself, but what is driving that?
You know, it's the stagnation of middle-class incomes, the relatively low mobility that we have, the disappointing level of wages over a long period of time. It's all of a piece, and it all does go to that. And I think the causes of these things are really deep. It's not something we can address really successfully over time with monetary policy, as you say. So I think it's,
what are those deep causes?
So I think you know, part of it is, in our case, in the case of the United States, stagnation of educational achievement, the leveling out of educational attainment. When U.S. educational attainment was rising, technology was coming in. It was asking for more skills on the part of people. They had those skills, and so you had productivity rising, you had incomes rising, you had inequality declining over a long period of time. U.S. educational attainment flattened out in the 1970s, and everywhere else in the world it's been going up. We really had a lead. We were the first country to have gender-blind, secondary education universally. So that's a big thing. Really the only way for incomes to go up over a long period of time is through higher productivity. Really, that's real incomes go up over a long period of time because of higher productivity. Higher productivity is a function of, in part, the educational and skills and aptitude of the workforce. It's also, partly the evolution of technology and investment. I think right now, in particular, we had a number of years of very weak investment after the crisis because there was no need to invest. That weak investment period is casting a shadow over productivity right now, which is one of the main factors that's holding down wages. So these are deep, hard problems, but I mean, education is really at the bottom of the pile.
And I'm glad you alluded to that, and my time's up, I know, but we actually have had productivity growth without wage growth.
Over long periods of time, the only way wages can go up sustainably is with productivity growth. They don't necessarily match all the time. I mean, since the crisis ended, productivity growth has been, output per hour has been very, very weak. Increases have been very, very weak.
Thank you, Mr. Chairman.
Senator Tester.
Yeah, thank you, Chairman Crapo and Ranking Member Brown. And thank you for being here, Chairman Powell. I want to run over some stuff that's been run over already, just real quick. It answered in a previous question that the stress tests continue. Is that correct? Stress tests continue on the banks.
Absolutely, every year.
And you said you were going to try to improve them, make them more transparent, which, by the way, I applaud that. Would you also add to that list that you are trying to weaken the stress test?
No, absolutely not.
Right. You're still making them do what they need to do to prove that their soundness is there.
The 2018 stress test was by a margin the most stringent stress test we've done yet.
Okay. Folks also continue to be concerned that S2155 allowed foreign mega banks like Deutsche Bank, UBS, Barclays to see their enhanced prudential standards weakened. You have agreed, and you said it again today, that 2155 doesn't do that. Do you have any plans to weaken standards on the largest FBOs that I mentioned?
No, sir.
Okay. In your testimony, you said good economic performance in other countries has supported exports and manufacturing. Could you, what other countries would that include? The EU? Would that include Canada and Mexico? The other countries I'm talking about that have good economic performance, would that include China? Those other countries.
It would include all those countries.
All those countries. So, and I know you said that the tariff situation is, and the trade situation is something that Congress deals with that you don't deal with, but it would appear to me, and I just want to get your opinion on this because I value it, it would appear to me that all this stuff about getting out of NAFTA and putting tariffs on folks and not being at the table when TPP was finally signed is a net negative on our economy. Would you agree with that long-term, short-term and long-term?
So I'm going to try to walk that line that I mentioned earlier and not comment on any particular policy, but in principle, open trading is good. We don't want countries to have barriers to trade or tariffs being a barrier to trade.
Both directions.
In both directions. We want to have an international, rules-based system. in which countries can get together, and any country that violates that can face the other countries, and that system has served us very well. Tariffs have come down steadily over the years. Until recently, they were at their all-time low level. So, but the thing is, we don't know how this goes. This process we're in right now, the administration says it's going for broadly lower tariffs. If that happens, that's good for the economy. That would be very good for the economy, our economy, and others too, by the way.
Yeah.
On the other hand, if we wind up with higher tariffs, then not so good.
That's correct. And in the meantime, just as a sidebar, in the meantime, if it cuts off foreign markets for grains, for example, there's going to be a lot of people in family farm agriculture that are put out of business. And that's my concern. You don't need to comment on that. I realize that you don't play a central role in our housing finance system, but you do play a central role in our economy. And the Fed does have a sizable balance sheet with billions of dollars worth of mortgage-backed securities on the books. In March, it was announced that Fannie Mae and Freddie, Fannie Mae would need, not Freddie, but Fannie Mae would need $4 billion from its line of credit at the Treasury Department. How concerning is this to you and the Fed, given the size of mortgage-backed securities that are on your books?
So the mortgage-backed securities we have are guaranteed by the federal government. There's no credit risk there. I would say more generally, if this is responsive, I think that the housing finance system, the GSEs, remains one of the big unfinished pieces of business post-financial crisis, and I think it would be healthy for the economy and for the housing finance system to see that move forward.
You answered my second question. So you think that the Congress's inability to address Fannie Mae and Freddie Mac in the end could harm our economy?
I think it's really important that for the longer run that we get the housing finance system off the federal government's balance sheet and using market forces and some of the things that are already in place and carry forward some kind of a reform. I think it's very important for the economy longer term.
Okay. Thank you, Chairman Powell. I appreciate being here. I got a couple other questions for the record that I'd love to have you answer, but thank you very much.
Thanks.
Senator Toomey.
Thanks, Mr. Chairman. Thank you, Chairman Powell, for joining us. Just a quick follow-up on this wage discussion. I think the most recent numbers we had were the month of June. Comparison to the previous June, 2.7%, I think, was the nominal growth in the wage number. So obviously a positive number. I think we would all like to see a bigger real growth. I think there's no question we'd like to see that. But I would suggest that there's something peculiar about just the arithmetic of this sometimes, and maybe you could just briefly comment on this. If the economic growth, as our economic growth has coincided with a significant growth in entry-level jobs and people coming into the workforce at entry-level wages, since those wages are at the low end of the wage spectrum, isn't it the case that the nature of arithmetic is that the average wage will reflect to some degree the fact that new entrants naturally come in at the low end of the spectrum, and it would mask the growth in wages of people who've been continuously employed?
Yes, that's right. There can be compositional effects, is what we call them. So younger people coming in lower wages, older people higher wages, retiring can be an effect. I'm not sure it is right now, but I can check on that.
I think that's likely to be the case as we have increasing workforce participation. I think that's a likely consequence. You made a very important point, I think, earlier, that sustained wage growth absolutely requires sustained productivity growth. It's not possible to have the former without the latter. We all know that productivity growth is driven by several things, but one of the principal contributing factors is capital expenditure. It's new tools and equipment and technology in the hands of workers that make them more productive. The June FOMC minutes included a disturbing observation, and I'll quote very briefly. It says, "Some districts indicated that plans for capital spending had been scaled back or postponed as a result of uncertainty over trade policy." So the FOMC is saying that there is already adverse consequence in the form of scaled back investment as a result of uncertainty in trade policy. If there's more uncertainty, and we have threats of additional tariffs hanging over the markets right now, doesn't it follow that this is a threat to wage growth? Because the continuum includes a reduction in capital expenditure, lower productivity growth than we would otherwise have, and a corresponding relative weakness in wage growth. So in other words, isn't all this trade uncertainty a threat to wage growth?
It may well be. We don't see it in the numbers yet, but we've heard a rising chorus of concern, which now begins to speak of actual CapEx plans being put on ice for the time being.
Yeah, which is really disturbing. The stagnant, to the senator from Tennessee's question about what causes stagnant wages, well, it corresponded to an extended period of very low productivity growth, which itself corresponded to very low capital expenditure growth. We broke that with the incentives in the tax reform that caused a big surge in CapEx. And it would be a tremendous pity to jeopardize that because of the trade policy. Let me move on to a somewhat technical matter regarding the Fed's balance sheet. As you know, historically, the Fed has manipulated just overnight rates, the discount rate and Fed funds rate, and let the markets decide all other interest rates. That all changed with quantitative easing when the Fed became the biggest market participant in the purchase of treasuries. And it changed in an explicit way when the Fed decided that it would intentionally manipulate the shape of the yield curve with the Operation Twist, which was very consciously and willfully designed to change the shape of the curve. My understanding is now, to the extent that you make purchases of treasuries, which you do when payments come back to the Fed in excess of what you want to run off, you do so basically as a set proportion of what the Treasury is issuing without regard to where on the curve they're issuing. So while this is happening, the yield curve is flattening in a pretty dramatic way, right? 2s, 10s were like 100 basis points a year ago. Today they're, I don't know, 25 basis points. Some people are concerned that a flattening curve or an inverted curve correlates with economic slowdown and recession. Here's my question. Does a dramatic change in the shape of the yield curve in any way influence the trajectory that you guys are on with respect to normalizing interest rates and the balance sheet?
In other words, are we going to change our balance sheet policies due to the, is that what you're asking, due to the changing shape of the curve?
Does the changing shape of the curve weigh into your considerations at all?
You know, I think what really matters is what the neutral rate of interest is. And I think people look at the shape of the curve because they think that there's a message in longer run rates which reflect many things, but that longer run rates also tell us something, along with other things, about what the longer run neutral rate is. That's really, I think, why the slope of the yield curve matters. So I look directly at that rather than, in other words, if you raise short-term rates higher than long-term rates, then maybe your policy's tighter than you think, or it's tight anyway. So I think the shape of the curve is something we've talked about quite a lot. Different people think about it different ways. Some people think about it more than others. I think about it as really the question being, what's that message from the longer run rate about neutral rates?
Yeah, I think that makes a lot of sense. I see my time has expired. Thank you, Mr. Chairman.
Let me check.
I got in on
Senator Warner.
Thank you, Mr. Chairman. Chairman Powell, it's great to see you again. Part of the challenge coming this late in the thing is a lot of my questions have been answered. I want to follow up, comment at least on what Senator Toomey is addressing. I do think, I was going to cite the minutes of the Fed June meeting as well in terms of, well, you say you've not seen these effects in the economy yet, but there has been a slowing of CapEx because of concerns about what I think is the President's kind of ill-thought-through trade war.